Good evening, everyone. Welcome to our Sacramento State Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. I know everybody's kind of getting into the Zoom session now, so we'll allow you to get all settled in and we'll get started in just a bit. As we get ready, I just want to give you some housekeeping notes or logistics for tonight's class. Our runtime for tonight's class will be just about an hour. Throughout tonight's class, we really encourage interaction with our audience. So if you have questions, want us to kind of review a topic again, you can use the Q&A or chat function within Zoom, and we'll go ahead and answer all those questions or, get any feedback on air. And this, like I said, this is a very interactive class. We're going to kind of touch on a bunch of different aspects of first-time home buying, and we're really excited to bring this content to you. So this is our second installment of our classes with our Sac State Alumni and Athletics Partnership. But this is our second year of partnership, and we're just really proud as a local business to be in partnership with Sac State Alumni and Athletics. So we're excited that you're also joining us for tonight's class. And if you do like some of this information that we're sharing with you this evening, we do teach classes very similar to this throughout the year. And so you'll learn a little bit more about how to attend some of our other future classes. And tonight's class is being recorded, so we'll go ahead and have this up on our YouTube channel tomorrow. You can look back at all the recorded information. We're also going to share with you all of the presentation material. So since you signed up for tonight's class, you'll get the email distribution of tonight's deck page. All right. So we're going to allow the rest of our guests to get settled in. I know we're just a couple minutes past the hour, so we'll just allow everybody a few minutes to get going. Before we get going, I should say. And like I said, this is a very interactive class, so feel free to use the Q&A chat function, and we'll answer any questions or comments on air. All right, and let me just go ahead and just, while we're waiting for Russ to join here, just a little bit about me. My name is Jason, and I'm a branch manager with American Pacific Mortgage. So we're a local mortgage company here in Sacramento. Our particular branch focuses on home buyer education, and so what we do is we support different alumni partnerships all across the country. So it's nice that we're getting a chance to teach this class in our backyard tonight, which is great. But we do get a chance to teach this class all across the country. We specifically kind of focus in on first-time buyer resources that are available to you. So as first-time buyers, we help kind of educate you through the process. And then when you decide to purchase a home, hopefully you'll be able to leverage some of these resources. So we work with a state agency also called CalHFA. It's the California Housing Finance Agency. So you're going to learn a little bit more about that agency later on tonight. And we are based in downtown Sacramento, but as a company, we're a nationwide lender. All right, so that's a little bit about us. And let's talk a little bit about our talking points for tonight. So we're going to spend some time looking at the housing market in just a bit. I also want to spend some time looking at interest rates and what's influencing interest rates in today's market. We are going to do a rent versus buying calculation. So we're going to talk about, as we're looking at continue to rent, what could that look like if I change things up a little bit and decide to purchase a home? We're going to talk about credit, how to improve our credit as we're preparing for home ownership. We're also going to look at student loans and how those could influence maybe my eligibility for my home buying. We'll talk about loan programs, some of the documentation we want to get together. So if we're thinking, yeah, I want to get on that path towards home ownership, what are some of the documents that we want to try to get together as we kind of prepare our qualifying? As I mentioned earlier, we'll talk about down payment assistance programs, and then we'll wrap up tonight's discussion looking at the loan process. So if you, after leaving tonight's class, you say, hey, you know what? I really like to build a home buying plan for myself and set some goals and objectives for home ownership. We'll help you with that through our consultation services. All right. So that's what tonight's class looks like. And then again, have some questions as we're going through tonight's presentation. Don't hesitate to use the Q&A or chat function in Zoom. So let's talk a little bit about home buying, because this, as you think about home buying, is probably going to be one of the biggest financial decisions you decide to make in the next several years. And I think as you consider home buying, we want to consider some of the benefits that also come along with home ownership. So you have the opportunity to create more affordability for yourself potentially, because now we're controlling more of our housing budget. We're not having to worry about maybe a landlord that's increasing rents on us. This is an asset that will hopefully appreciate over time. So as you pay down your principal balance on your mortgage and then the market value of the home goes up, the difference between those two figures is home equity. And that equity can potentially create generational wealth over time. And there's also some really great tax benefits that come along with buying. So when we go into our next exercise, which will be our rent versus buying calculator, we can factor in tax benefits like deductible interest that could potentially be available on within home ownership. So what we're going to do now is we're going to kind of go through a rent versus buying calculator, because I think it's important as we launch into tonight's class. It's really important to understand those differences that make up buying versus renting. So this next screen that we're going to look at is going to be through our Freddie Mac rent versus buying calculator. In case you missed it earlier, all of our presentation material is going to get sent out to you tomorrow, which will include the link to this calculator. But I want to kind of walk our audience through this calculation so you can get a sense of what this looks like. And we're going to have some kind of pre-filled numbers in here just for time purposes, but I want to kind of walk you through what this would look like. So we're going to first start off on the rental side. So I'm going to open up this rent tab here. So we're going to assume that we're paying rent at $2,500 a month in rent. We're also going to assume that we're paying renter's insurance of about $15 a month. And then the last assumption around the rental side of things is that our rent's going to go up about 5% on an annual basis. All right. So that's on the rental column per se. Now, from a home purchase perspective, we're going to say we're going to buy a $500,000 house. We're going to assume a minimum down payment of 3%. Now, you're going to look at, you're going to be able to look at different loan programs in tonight's discussion, but the minimum down payment for a first-time buyer is 3% of your purchase price. We have estimated property taxes based upon that $500,000 purchase price. We have homeowners insurance. We're going to factor in maintenance costs of our home. So if we're thinking about purchasing maybe an older home, that obviously would probably carry with it a little bit more in maintenance costs. We have the loan information tab. And so under loan information, we assume a 30-year fixed mortgage. We're going to put in, interest rates are up a little bit today. So let's go ahead and change that. We're going to make that a 6.875. Let me just make a quick adjustment there because rates are up a little bit from when we did this screen. We have origination costs. So that's what our lending costs are going to be. By the way, because of our partnership with Sac State Alumni and Athletics, we pass along discounted services to you. So we actually lower our origination cost by $750. So that's one of your benefits as being a Sac State alum. And then I just want to kind of explain this field here. This are discount points. So when you purchase a home, you do have the option at times if you want to buy down your interest rate. So what we're looking at in buying down an interest rate, where you're basically paying additional funds out of pocket to bring down an interest rate. So if the market rate is at 6.875, but you really want to get down to 6.625, you could pay additional funds out of pocket to lower that interest rate. All right, we had a question that came in, and I'll continue on with the calculator. Can you qualify for a first-time buyer if your name was added to a home loan during a refinance? Now, and so let me kind of touch on what I'm going to ask Ken, who's supporting us here tonight in tonight's class. We're going to table that question here just because we're going to do a full first-time buyer dive in. So for the audience member that gave us that first-time buyer question, I'll definitely answer that in tonight's class. The other component of this calculator is going to be other settlement services. So those are going to be things like title and escrow fees as part of your home purchase. These are all kind of encompassed or centered around closing costs. Closing costs are generally about 2 to 3% on estimate of your purchase price. Okay, that's so if we were buy $500,000 purchase price, I would probably estimate somewhere around $10,000 to $15,000 in closing costs. Ultimately, that's going to come down to what you negotiate with the seller, but I think as a baseline, that 2 to 3% is generally a pretty good estimate. And then the last section is our other assumptions. We're going to assume our home's going to appreciate 4% annually, that we'll be in this home for 7 years, that eventually when we sell this home, we'll have some expenses that come along with that, like the realtor cost to sell the house. We have state and federal tax rate, and then we have an estimated savings rate. So what our calculator does, it first of all compares our payments, right? So we know that our rental side of things is about $2,500 a month. From a budgetary perspective, we have to know that that payment in today's housing market is going to go up. So it's going to go up to about $4,300 a month. So you're going to have about an $1,800 uptick in outgoing expenses. The trade-off to that is that you have the upside of ownership. And by the way, we're comparing this side by side over 7 years. But at the end of 7 years, if I decided to own versus rent, I'm going to have about a $67,000 opportunity of owning versus renting. And you may ask, well, how do we get to that number? Well, if we factor in tax deductions of potentially interest, and then we look at the appreciation of my home based upon a 4% average appreciation rate, at the end of 7 years, my upside is about $67,000 by owning versus renting. Now, that could potentially change over time. As existing homeowners go, you do have the option to refinance a home down the road. So let's say we buy a house in 2024 and in 2026, I decide to refinance. Well, if I can bring down my interest rate, that in turn brings down my payment. And essentially, I'm going to have a better upside in my calculation of rent versus buying because my affordability will look a little bit different. But that's one of the exercises I think that's super important to do as we start on this path towards home ownership. I would encourage our audience, when you have some time, once you get the presentation material, take some time to do this calculation on your own. I think you'll find it super beneficial as you're considering home ownership. Now, one of the big considerations is what's the housing market doing right now? So I would guess most of our audience members are from the greater Sacramento area. And the Sacramento housing market looks very similar to the rest of the country. We have a few challenges in today's housing market. Not only are we seeing prices rise, which obviously is a challenge, but the reason why they're rising is primarily because of a few different reasons. One is we just don't have a lot of inventory on the market to support buyer demand. So believe it or not, even rates at 6.8, 7%, we still have really strong buyer demand out there. Now, while new home construction is trying to fill some of the need in the inventory, there still remains a bit of a gap there in inventory levels. And when you have a shortage of inventory, but you have strong buyer demand, what's that going to do? Well, it's going to push prices up. And so that's kind of what we're seeing in today's market right now. So you can see kind of our elevation in the median home price, right, moving up to about $513,000. You don't see homes staying on the market very long in the Sacramento market either. So you're seeing 11 days on market. So things are coming on market. They're starting to sell really fast. And I think the second really big thing what happens in the Sacramento housing market per se, we are seeing another wave of Bay Area migration. I work with clients all across the state and across the country, but specifically when we look at the Bay Area market, we are seeing, Bay Area buyers that are saying, wow, in today's market, I can afford a lot more in the Sacramento market. I think in some respects, the Bay Area has kind of hit a little bit of a tipping point in cost. And so that's why I think you're seeing this kind of next wave of Bay Area migration. So that's obviously, leading to an upward swing in prices. Now, interest rates are playing a role in buyer demand to a certain extent, so it's pushing some buyers to the sidelines because with interest rates being in the position they're at, average of about 6.8 to 7%, not everyone can afford to be in today's market. But I think it's important to understand, like, how are we at this level of interest rates? Because when we look back at 2020 and 2021, rates were in the 2.5%, 3% range. Now, well, today we're at 6.8 to 7%. Why we're here in today's market is really attributed to what's going on with overall cost of living and just the inflationary environment that we're in today. When you go to the grocery store, it's a little more expensive. You go out to eat in a restaurant, a little more expensive. The fuel that you put in your car, it's more expensive. All that is driving those inflationary costs right now. So the Federal Reserve has tried to combat inflation by raising interest rates. And so that's what we've kind of faced over the last 2 years, trying to drive down inflation. The Federal Reserve's goal in inflation is 2% inflation. We're well over that, but we're right around 3% inflation. We are looking forward to the day when the Federal Reserve decides to cut interest rates, because obviously that'll give us some relief on the mortgage side of things. There is speculation that the Federal Reserve will cut interest rates in September. So we're all kind of hoping that that happens. But, you can look at this chart and see kind of what we've faced over the last year in interest rates. In October, we saw interest rates rise to 8%. Of course, they've swiftly come down since that, but obviously that was a really challenging time in the markets. And then we've kind of bumped around in interest rates. Just 2 weeks ago, we were at 4-month lows in interest rates. We saw some of our first-time buyer rates get as low as 6.625, but I still think for the balance of 2025, we're probably going to, or 2024, I should say, we're going to see kind of rates kind of chopping around a little bit in that high 6 range, maybe get into the mid 6s by the end of the year. And then hopefully as we move into 2025, we might see sub 6% rates. I don't think we're going to see more kind of historical levels of interest rates like in the 5.5, 5.25 range until we get to maybe 2026. I hope I'm wrong. I hope that's a lot quicker than that, but I think that's kind of the pace that we're seeing in today's market. Now, interest rates aren't the same for all buyers, and I think that's important to understand. So there's different characteristics that go into interest rates, things like credit score. So the higher my credit score is, the lower my interest rate could potentially be, the type of product I select, how much I decide to finance, what my down payment is. So if I'm putting down 3% versus 20% down, that's going to change the level of interest rate that I have. And then we talked a little bit about it earlier, which is discount points. So if I decide to pay additional funds out of pocket to bring down my interest rate, those are called points. Usually 1% of my loan amount equals is a point. And so if I finance $400,000, that 1 point would cost me $4,000. And generally that'll equate to about a 0.25% reduction in interest rate. And finally, the term of my loan can also influence my interest rate. So the shorter my term in a normal market would help also bring down my interest rate. Now, as we meet with you, hopefully for a consultation at some point to provide you with your, kind of roadmap to home ownership, we're kind of figure out what product makes the most sense for you based upon your goals and objectives for home ownership, and obviously to create affordability for you. So one of the big factors that plays into interest rates, as well as our overall home buying plan, is credit. So we always like to kind of talk a little bit about credit in our classes. So we're going to first talk about the FICO score calculation and what goes into it. So there's 3 different credit score models. There's the mortgage model, there's the credit card model, and then finally there's the auto model. Now, for those of you that use monitoring services like Credit Karma, maybe some of the agency products like Experian, Equifax, or TransUnion, they're generally going to give you the credit card model. When you're applying for home financing, obviously it's going to be the mortgage model, so it looks a little bit different from a risk calculation perspective. And this is what goes into the weighting. So we have 15% is going to be how long have I had credit. So the more mature my credit file is, the potential higher my credit score is going to be. 20% is going to be how much new credit am I trying to get access to? So am I opening up a bunch of new accounts? Have I had some new inquiries on my credit, specific to hard inquiries? Just as a side note, we always start our process with a soft inquiry. And the reason why we do that is because soft inquiries don't impact your score. Eventually, we will need to do a hard inquiry, but initially for the pre-approval process, only starts with a soft inquiry. 30% is going to be how much do I owe on my revolving credit balances. So that's also known as credit utilization. So if we were to look at credit utilization, and let's say we have $10,000 in limits and maybe $5,000 in balances, that means I'm at 50% utilization. If you're trying to optimize your credit score, I'd encourage you to get down to 10% or less utilization. So that means that balances need to be less than $1,000. Let me give you a quick tip on how to manage your utilization. If you were to look at one of your credit card statements tonight, there's going to be 2 key dates on that statement. There's a statement date or a billing cycle date. There's also the due date. So many of us in tonight's class might be in the practice of paying off or paying down our credit card by our due date. But from a credit reporting perspective, that is after the statement date. And so you may not get the benefit of lower utilization. And so what I would encourage you to do, try to pay down or pay off your credit card balance before the end of that statement date, because on the statement date is when the credit card issuer sends out all your account information out to the agency. So if you can pay that down quicker, you'll have a lower balance, lower utilization, and hopefully a higher credit score. 35% is going to be my payment history. So how well have I paid my accounts? Obviously, if we've had any late payments, those are going to jeopardize that credit score. If there are late payments on your credit report, they're rated as 30-day lates, 60-day lates, and 90+ day delinquencies. So yeah, obviously we want to avoid any type of late payments. If you've had a late payment, the impact to your score will be in the most recent 12 to 24 months from the date of the event. So the further I can get away from that delinquency, so if it happened in October of 23, once I get outside of 12 months, a little bit of improvement. Once I get outside of 24 months, you might see a little bit more improvement as well. All right. Now, each agency, so Equifax, Experian, and TransUnion, has different risk models to their scoring. So you may have a different score on each one of those bureaus, and it's just because they're assessing your risk differently. Now, every product has a minimum credit score. You can kind of see those on screen with the FHA product, conventional loan, our VA product for our veterans that qualify under the VA home loan. And then for the first-time buyer product under CalHFA, there's minimum credit scores. So that's kind of how all products set up. There's also other guidelines within each one of those programs. We'll talk a little bit more about that in just a bit. Now, larger events on your credit report, like maybe a bankruptcy or a short sale or collection, those are going to have a longer kind of impact to your credit score because they're major events. But the same thing holds true as we get further away from the date of the event. We should start to see kind of organic improvement in our credit score. Now, if you're considering closing out a credit card, so a revolving account, be careful with that, because when you close out a credit card, it does two things. One is it takes away all that great history you've had over that course of time with that credit card, but it also lowers your credit limit. So you lose kind of one of the credit cards or credit lines within your aggregate totals. So that could also jeopardize your utilization as well. All right. So the question in the chat was, is the FICO score your credit card score? So the FICO has different models too. There's the credit card model, like I said, in mortgage and auto. If you're looking at like a monitoring service, that's going to be your credit card score. Okay, another question in the chat was, what if you and your son or partner is planning to buy a house, but one credit score is much better than the other? Does the person on the loan look at both, or does the loan agency look at both, or an average of the credit score? So great question. So that's one of our talking points tonight too. So as a lender, we look at the lowest middle score between both borrowers. So here's an example of that. So let's say I have my high score of 760, middle score is 740, and my lowest score is 720. So we have a middle score for one borrower at 740. Now, if my partner's score is 700, 680, and 660, the lowest middle score between the two of us is 680. So that would be the score that we would use for qualifying purposes. That's going to, take part into your interest rate, product selection, and probably mortgage insurance as well. And we're going to talk about that a little bit later in tonight's class. The other question was, if my credit utilization before my student loan becomes due was 8%, I think it was 8%, I think. Okay, yeah. However, now I'm over the 80% because I owe more on the student loans. Is this going to impact my credit score? So student loans are installment debts, just so everyone knows. So that doesn't impact the utilization side of things. So utilization of credit is just going to be credit cards, personal lines of credit, overdraft protection will be like a line of credit, that kind of stuff. So student loans shouldn't play a role at all in utilization. All right. Great questions, everyone. I wanted to share with you a matrix on how long like negative items would stay on your credit report. So like hard inquiries, I know it doesn't necessarily sound like a negative item, but it does impact the score potentially. Those will remain on the credit report for the most recent 2 years. Now, the impact on inquiries will be in the most recent 6 to 12 months. So obviously we want to avoid inquiries. Just as a quick side note, there are credit rules in place when you're applying for a mortgage as it relates to hard inquiries. So if you apply for a mortgage, you do have a 30-day window of time to shop around with as many lenders as you choose to, and it's the equivalent of one credit inquiry hit to your score. That same credit rule applies to auto financing as well. So you can shop around for different auto financing lenders, and it will be the equivalent of one credit inquiry hit to your score. So you have basically a 30-day window of time. So student loans come up in the buying process as a conversation we're having with clients. I know most federal student loans that you have today are in repayment. Now, if you're back in school and you're in a deferment situation, or maybe you're still on a forbearance program, there still is a minimum payment that has to be counted into the calculation if you're trying to qualify for home financing. So that, even though they're on deferment or forbearance and no payment is due, we still have to factor something in. Now, if you're in active repayment, and let's say it's an income-based repayment amount, we can use that payment. So whether it's a zero payment IBR, or let's say you have $75,000 in debt and you're on a $250 a month payment, that $250 a month payment would be factored into the income-based repayment, or the qualifying, we will use that income-based repayment amount. Now, if you're not set up on any type of income-based program, The default number for a conventional loan is usually 1% of the aggregate totals of your student loans. For an FHA loan, it's 0.5% of the aggregate totals for the monthly payment. So those are things that we'll talk through in our one-on-one conversations with our clients, because the reality is for those clients that we do work with, that student loans might come up, and so we want to make sure you understand kind of how we need to document those things. Now, some of our clients are also on public forgiveness, where you're working for a public entity and they'll be forgiven after 10 years. Until they have been forgiven, I still have to count a minimum payment into the qualifying. And then, of course, if you're getting cancellation of student loan debt, that's even better. But until that student loan debt is canceled and you have documentation for that, we'd still have to count some type of minimum payment into the qualifying. All right. Any questions on student loans before we kind of jump into the loan program side of things? All right, let's go ahead and talk a little bit about loan programs. I shared with you earlier that kind of each loan program has specific minimum credit score requirements. I want to dive into a few of the characteristics as it relates to different loan programs. And so let's kind of take a look at what that might look like for you. And so on the first product we're going to spotlight is the conventional loan product. When you think about conventional loans, those are Fannie Mae, Freddie Mac products. And so, those agencies, have had you kind of hear those come up quite a bit when you're thinking about the housing market. Fannie Mae and Freddie Mac has about 70% of all originations across the country. That is a conventional loan with a minimum down payment of 3% for first-time buyers, up to the conforming loan limit, which is 766,550. By the way, that conforming loan limit changes each year. So right around November of this year, we'll have a new conforming limit. It changes based upon cost of living, and it's set for the entire US. However, in different kind of areas like high cost of living areas, there's higher levels of loan amount that we can go to. Sacramento has a slightly higher loan amount that we can get to. However, when you go beyond the conforming loan limit of 766,550, that minimum down payment of 3% jumps to 5%. That's just on a conventional product. So if we have some guests in tonight's class that are joining us from, let's say, San Jose, so big surprise, San Jose is a high cost of living area, right? So we can go up to 1,149,850 in loan amount in that market. At the same time, the minimum down payment would elevate to 5%. Minimum credit score on the conventional loan is a 620 credit score. Different from the FHA product, is going to have a slightly higher credit score. We're really looking for a buyer that's going to have a little bit less events on their credit report to qualify under the conventional product. When we look at the FHA loan, which is a federally insured loan, has a minimum credit score of 580. It will have a lot more flexibility and guidelines as opposed to the conventional loan. Whether you're within the conforming limit or you're up to the high balance limits, FHA has a minimum down payment of 3.5%. So a lot more flexibility in FHA if I had a late payment, or maybe I have a higher what we call debt to income ratio, which you're going to learn about a little bit later in tonight's class. We're going to do a quick comparison in just a few minutes on mortgage insurance as it relates to conventional versus FHA, so you can have a better understanding of that. The next product is the VA home loan for our veterans that have eligibility, minimum credit score of 620. The VA home loan has a lot more flexibility in the guidelines, allows the veteran to hopefully have more purchasing power, a little more flexibility if there's been some credit challenges. So the VA home loan is a great product, and that's something we can obviously support our veterans with. There is no cap in loan amount with the VA home loan. So you can go finance $1 million if you want on a VA loan, and that completely is allowed. And VA has a 0 down payment option. For our first-time users of VA, there is a funding fee. Usually it's about 2.3% of the loan amount that gets financed in for you. Now, if you have any type of partial disability from the VA, generally that funding fee is completely waived. Next two products on screen are the USDA product. That's for clients that want to buy in more rural areas. There's two kind of big qualifiers for the USDA product. So while it's a 0 down payment option, there's only certain geographic areas that qualify under USDA. There's also household income limitations with the USDA product. And then the jumbo loan are going to be for clients that need to purchase at a little bit higher level of amount finance. Usually requires 10 to 15% down payment. There are more asset requirements in that you need to contribute both your down payment and then closing costs, which we talked a little bit about earlier, but there's also generally reserve requirements. And that's where you have additional assets, which are generally the equivalent of 12 months of my monthly payment that are set aside in maybe a 401k, or maybe in a cash account or a brokerage account. So if I have, let's say, an $8,000 mortgage payment times 12, I would need an additional like $96,000 in assets after I've contributed my down payment and my closing costs. Let's talk a little bit about mortgage insurance, and that's a conversation that comes up quite a bit with our first-time home buyers that we consult with. So I want to do a quick kind of a dive into mortgage insurance and the mechanics and the features of it. So let's talk first about conventional mortgage insurance. There's different payment options for conventional mortgage insurance. Most buyers will elect monthly mortgage insurance, where it's included in my monthly payment. But there's also other options like what we call a split mortgage insurance, where you pay some of it up front, some of it on a monthly basis. There's also single premium mortgage insurance, where you completely buy out the mortgage insurance and it increases your cash out of pocket. There's also lender paid mortgage insurance, not a super popular option, especially in today's higher interest rate market, but it ultimately allows you to elevate your interest rate in order to buy out the mortgage insurance. Now, mortgage insurance is different for all clients, and it's based upon a few different characteristics. It's going to be based upon your credit score, what your amount financed is, and how much your down payment is. So the higher I can move that credit score, the more I can put down, the more reduced my mortgage insurance is going to be. You know, if you've already started some of your home search on Zillow or Redfin, they do have calculators that are available to you. What I have found is those calculations aren't very accurate because the mortgage insurance is significantly higher. It's not really usually calibrated to some of these characteristics. So just something to kind of keep in mind. We have a really great mobile calculator that I'll kind of highlight a little bit more for you later on in tonight's class. Now, there is a cancellation option on conventional mortgage insurance. And what that cancellation option states is that once I have 2 years in the home and 20 to 22% equity, you can potentially apply to have the mortgage insurance canceled. So let's look at what the cost of mortgage insurance looks like on a conventional loan. So if I finance, let's say $450,000, I was going to put 3% down for my purchase price. I had a 740 credit score. My mortgage insurance from a monthly perspective would be about $183 a month. So if you've done some calculations on Zillow or Redfin, that number is probably almost half of what you've probably seen in some of those calculations. Now let's look at FHA mortgage insurance. Now, the FHA is a government insured loan, so the mortgage insurance looks a little bit different. There's two forms of mortgage insurance on an FHA loan. So there's upfront mortgage insurance, which is the equivalent of 1.75% of my loan amount. There's also monthly mortgage insurance, which is 0.55% of my loan amount. And that mortgage insurance does not change by credit score, and it really doesn't change by down payment. The only way to cancel mortgage insurance, well, on an FHA loan, you really don't have the option to cancel. You just have to refinance out of the FHA loan in order to, basically move to maybe more of a conventional loan once we're in a better equity position. So if we look at the FHA calculation, same loan amount, $450,000. We have the upfront mortgage insurance of 1.75% that gets added on, so that'd be about $78.75. And then we have the monthly cost, which is $206.25. So a little bit more of an uptick versus the conventional loan. Now, the question you're going to ask yourself is, why would I go the FHA path if I know the conventional product seems to be a lot cheaper? And that's absolutely right. But at the same time, I think it's really important for our clients to understand not all clients are going to qualify under conventional loans. So FHA can be a really great alternative for clients, especially if you've had some past challenges. So the guidelines look different within an FHA loan versus a conventional loan. For example, let's say I had a bankruptcy that was 3 years ago, right? The conventional product would have to see a four-year kind of reprieve from the bankruptcy versus FHA would allow you to do financing after 2 years. Or if I had some late payments on a student loan last year, it would be pretty difficult with a conventional loan versus FHA would be more accepting of that. And so those are the things we kind of look at to see what the right, support mechanism is to help our buyers. The one thing I just want to make as a footnote, if you have started home shopping or kind of comparing loan products, what you'll find, especially if you Google FHA interest rates right now, those FHA interest rates will look significantly lower, maybe 0.5% lower than a conventional product. But it's a bit misleading because the FHA product from a mortgage insurance perspective is much more expensive. So just something to be mindful of as you kind of start on that path, that FHA interest rates will look a little bit different, but the overall kind of expense structure is a bit cheaper on the conventional product. So let's kind of continue on and talk more about documentation that's needed. And we're going to spotlight kind of more income-based items. Now, as we consider homeownership and gathering some items that we'll need to kind of evaluate eligibility, generally we need the last 2 years of taxes or 2 years of W-2s, 60 days of asset statements like bank statements, and then the last 30 to 60 days of pay stubs. So that's generally what we need. And as we kind of discuss income, I like to share with our audience kind of some of the things to keep in mind from an employment or income perspective. There is what we call a 2-year rule in place in financing where you generally have to show it as a potential buyer that you have 2 years of work history and or education. And so that gets a little bit confusing for some buyers, but ultimately, like let's say I graduated from Sac State in the fall and I just started my job in January. If I had 4 years of undergrad at Sac State and now I've started, in January with my new job, that history of education will count towards the 2-year requirement. So, some lenders will lead you to believe that you have to have 2 years on your job, but it's really not the case. It's a 2-year education and or work history. And then let's say you have a situation where you're thinking about transitioning to a different job. We can actually qualify you on that new job, which is with as simply as an offer letter for eligibility. So that is completely an option for you. So you don't necessarily have to be on the job 2 years either to have eligibility for qualifying. Now, where the 2-year rule gets a little bit more complicated, so to speak, is that if I have dual employment. So we see this in some fields like the healthcare industry, where we have some clients that are working at multiple facilities throughout the year. Well, in order to count both sources of income for those different facilities, I do have to show that I've had both jobs for 2 years. So, if it was working 30 hours at one job, 40 hours at the other, if I do want to count both sources, it has to be a 2-year simultaneous job situation. Same thing holds true for self-employed clients. So if I'm self-employed, 1099, or I have my own corporation, I do have to show that I filed 2 years of tax returns for that business consistently. So that's where that 2-year requirement may come into play. Also, if I'm working a full-time job, and let's say I'm driving for Uber or Lyft on the weekends as kind of more supplemental income, if I do want to count that additional income, I do have to show that I've worked both jobs simultaneously for 2 years. All right. Other questions that come up as I work with buyers, will be a situation where I'm working a 40-hour work week job, but maybe my spouse or partner who's not going to be part of the application, but contributes to the household, that in order to count that partner's income into the calculation, that person has to be on the application for eligibility purposes. We also hear from some of our clients that are renting out rooms and want to have that factored into the equation. For most loan products, we're not going to be able to add that income unless we're choosing a particular product that, like FHA, in some cases, if you do have some type of room rental, will potentially allow that supplemental income. And these are things we'll review with you during a consultation, but I think it's important to understand as you're preparing for home ownership, what some of those scenarios might look like for you. Now, one of the calculations that we use in evaluating eligibility is a calculation called debt to income ratio. And it's taking in consideration your pre-tax income versus your monthly expenses. And we're going to include the upcoming housing expense, things like credit card bills, personal loans, student loan debts. Those get all factored into the debt to income ratio. Generally, we don't want to see those expenses exceed more than 43 to 45% of that pre-tax income. And it's just a metric that we use for qualifying. It's not necessarily an affordability metric. Affordability really comes down to our one-on-one conversation we do together to kind of design some goals and objectives towards home ownership. So, even though you may qualify for a certain level of payment, we want to make sure that we kind of build a financing scenario with the most affordable payment. Here's what debt to income ratio looks like. And by the way, this calculation can also push all the way up to 50% for some of our clients. When we look at that breakdown, let me just kind of highlight this for you. So we consider the principal and interest of the loan. We take the property taxes of the new house, the homeowner's insurance of the new house. And if we're buying a condo or a townhouse or some of our single family homes that have homeowners association dues, that all gets set up in the housing budget column. And then we have other debts, like I said, credit card debts, personal loans get factored in. So let's say in this scenario, we have $2,500 in housing expense, $500 in other debts. We compare that versus an $8,500 a month income. That puts our debt to income ratio at 35.29%. Now, a lot of clients will ask me, well, Jason, what do you think the debt to income ratio should be? For most clients, I see the comfort zone around 33 to 36%, honestly. And while we can go up to 50% 50% debt to income ratio, I think it's really 33 to 36% is comfort. But there, in some cases, we can have clients that have other sources of income that just can't be documented. Well, that could be a reason to be able to, allow yourself to go to a higher debt to income ratio because maybe we're just not factoring other sources of income in your loan application. The last kind of thing we want to kind of spotlight in building what I would call is like a plan within our workshop is to talk about savings or assets for your home purchase. And so these are the typical pieces of documentation we would need to validate assets. So like checking and savings accounts for the last 60 days. We can't use cash deposits. Everything has to be seasoned from an asset perspective, 60 days. So if you've had some recently large deposits, those all have to be kind of paper trailed. You can potentially use retirement accounts, so 401ks, 403bs, IRAs. I'd encourage you to talk to your tax or financial advisor before you kind of access those assets because, we don't want to create any tax liability or, hurt the performance of your retirement. Gift funds where family members are supporting you in home ownership can be allowed. Now, there is no seasoning requirement for gift funds because those can be transferred right away. And then we kind of document how those are sent to you. Those are available for immediate family members to help you support you with assets for your home purchase. Now, two of the bigger challenges for home buying for most of our clients is credit, just because maybe we're overextended. It can be also just lack of savings for home ownership. I want to give you a really simple exercise for a savings plan for you. Because after this, we're going to talk about assistance programs, but let me just give you a quick little exercise that you can do, or maybe a discipline, I should say, that you could put into action for yourself today. And it goes like this. So let's say I simply put, I'm paying $2,000 a month in rent, but I feel like I'm pretty comfortable getting to a $3,500 a month mortgage payment. So that's a $1,500 gap, right? What I would encourage a client to do is if you feel like your budget can really go to $3,500 a month, but you're lacking savings right now for your home purchase, I'd encourage you to pay yourself like you're paying a mortgage payment at $3,500 a month. So what I mean by that is after you pay your $2,000 a month rent, take that additional $1,500, create the discipline of putting that $1,500 into your savings account every month. And before you know it, after 6 months, we have $9,000 in our savings account. After 12 months, we have $18,000. And believe it or not, that's sufficient funds to potentially purchase a home. It's a little adjustment in how you save, but I think that's really kind of the area of opportunity for a lot of buyers in today's market, just not having the savings to be able to purchase. Now, there are really great resources available to you as first-time buyers, and we're gonna kind of dive into these now. We partner with CalHFA, which is the California Housing Finance Agency, and it's designed to support low to moderate income households. You may have heard a little bit about CalHFA recently in the news. We had a big kind of product launch in April called the California Dream for All program. That program has since closed. We're now waiting for the lottery results to come out. Ultimately, what that program did is it provided up to 20% of your sales price in assistance. At the same time, there was a trade-off where you're giving up 20% of your appreciation of your home. That program, we'll see how it rolls out for 2024 in terms of the success rate after we kind of do a look back. But we probably will have that again in 2025, hopefully. So if it's something that's of interest to you, we'd encourage you to check out some more of our information we have on our website at mortgageeducate.com. We have kind of a whole resource center devoted to the Dream for All program. But we'll probably have lottery results for that program for those that applied sometime in the next week. Now, the programs that are available right now with CalHFA, one is the MyHome Assistance Program, which provides up to 3% of your sales price in assistance on a conventional loan, 3.5% on an FHA loan. And it basically allows you to get those additional assistance at a separate loan that's at a 1% simple interest rate loan. So it ultimately helps kind of reduce your total out-of-pocket expense. There's also the ZIP Assistance Program, which it basically stands for Zero Interest Program. It's going to provide you up to 2 to 3% of your loan amount in 0% assistance. Now, in today's market where interest rates are a little bit higher, the ZIP Assistance Program might not be as beneficial. Most of our buyers are electing the MyHome Assistance Program. There's two really kind of big benefits with the CalHFA first-time buyer program. Generally, the market rates are about 0.25% below market rate. So today's rates are at 6.875 today, which is a really competitive rate, but also having that MyHome Assistance to help reduce your total amount of funds out of pocket. So if we took a home buying scenario like we have on screen, let's say we bought a $450,000 house, we had a 3% down payment, and then we want to budget closing costs at anywhere between 2 to 3% of our sales price. So generally, without using assistance programs, I would probably need about $22,000 to $27,000 to purchase at that sales price level, right? Now, if I wanted to go to the first-time buyer route and take advantage of the CalHFA conventional loan with MyHome Assistance, now I'm able to get that slightly reduced interest rate, but also get up to $13,500 in assistance to help reduce my total out-of-pocket. So maybe my out-of-pocket is maybe 10 to 14,000 versus that higher number. And then if it worked for the ZIP assistance program, that could potentially be an additional funds that could help reduce my out-of-pocket. Again, in today's market right now, at least speaking, the ZIP assistance programs doesn't necessarily make a lot of sense because it elevates the interest rate beyond that 6.8. It's closer to 7.6. But the MyHome Assistance program in today's market is one of the really great tools that we use for to help support our first-time buyers. Now, not only do you have to be a first-time buyer using the CalHFA product, but there are income limits based upon the county. So we kind of spotlighted kind of our greater Sacramento area counties. There's income limits all across the state. If you're in San Jose, for example, the income limit's 300,000. So they're all at a variety of different levels. If you happen to be joining us from LA County, it's 194. And then you can see on screen kind of the local counties here if you're in the greater Sacramento area. Now, a first-time buyer is someone that hasn't owned a home as their primary residence in the last 3 years. So, the eligibility, is a very inclusive product because of the income levels, but also because of the first-time buyer designation. There are minimum credit scores by the loan program. So for the FHA program, it's 640. For the conventional product, it's 680. But there's also a low-income housing. So if you make less than 80% of the median income, you're considered low-income housing, and then the minimum credit score is 660. When we look at the income limits on this program, it's based upon applicant income, not household income. So a lot of first-time buyer programs look at the household size and whatnot. This is just looking at the applicant income. So let's say, for example, I really want to buy in Sacramento County. I make 180,000. My spouse makes 100,000. Now, if combined we make 280, we would be over the limit, right? But if I decided to just apply in my name, then I would be within the income limits and potentially be eligible using the program. Most properties are eligible under the program, but it has to be a one-unit property. So single family home, condo, townhouse. Manufactured homes are eligible if it's on land that's owned. So you can't do like a mobile home in a park or anything like that. We had a question in the chat earlier on first-time buyer programs, and I want to make sure that we got your question answered. I think I think it was more centered around income and kind of how we look at that. I think your question was more around deeds. If you're like on a past deed to a house. So the first-time buyer rule for our audience, again, I mentioned it earlier. It's if you haven't owned a house in the last 3 years. If you were on a deed to a house, if you haven't occupied that home in the last 3 years that you were on a deed to, then you're still considered a first-time buyer. So let's say, for example, we see this happen quite a bit. Let's say my parents own a home in Nevada and they live in that house, but they put me on the deed to the house just in case something happened for the family. So if I've never lived in that house in Nevada, but my name's on the deed, and I've lived in California for the last 3 years, I'm still considered a first-time buyer. Okay, so for our audience member that asked a very similar question to that kind of scenario I ran by you, hopefully that's helpful for you. Let's talk a little bit about the buying process. We've created kind of this visual tool to help you understand the buying process workflow. It's called our 6 steps of home buying. And the first step is really kind of the output of a consultation with us, because you've heard me talk a little bit about consultations. That's a free service we provide to our community where we're meeting with you one-on-one. That's me meeting with you to help design a home buying plan for you. And after we determine eligibility and set some goals and objectives for home ownership, then the output's going to be a pre-approval. And what a pre-approval does, it's a certificate that you get that allows you to start home shopping and really presenting offers to a seller. That pre-approval is usually good for 60 days, but it can always be recertified. Many of our home buyers take a year, maybe even 2 years to find the right home. Sometimes it's shorter, sometimes it's 1 or 2 months, but if it does take a little bit longer, we're here to help support you, whatever the timeline looks like. but that pre-approval can be recertified at any time. Step 2 is going to be house hunting. Most of your house hunting usually starts online and then it kind of transitions to in person once you find a few homes that you like. We'd encourage you to work with a local realtor that can help kind of guide you to communities that kind of fit your criteria. We have a really great list of preferred realtors that we work with across the country, even right here in the Sacramento market. And as you're doing your home search, if you need our pre-approval to be adjusted because you want that to match maybe a lower offer price on a home, we can do that really easily. So if we continue kind of down this process, let's say we make an offer on a house and the offer gets accepted. Now we're going to move to step 3. That's called entering escrow. Usually the escrow time period is a total of 30 days. So the time my offer is accepted to the time I get my keys usually takes about 30 days. Sometimes it's 21 days. We also have what we call a quick close program, allows us to condense that closing time period as short as 14 days. We've really found that to be super helpful for our buyers to help really make them more competitive in today's really competitive market, right? Now, what happens at step 3 is now the seller has accepted your offer. You're going to get a call from me congratulating you on your accepted offer. Usually within a couple of days from that acceptance, you're going to be required to make an earnest money deposit, which is usually 1 to 2% of your purchase price. And then we're going to schedule a follow-up consultation with you to go over the design of your financing. Make sure you understand what your selected interest rate looks like, the product that works for you, maybe assistance programs. So we're all going to do that to make sure you feel totally comfortable with the construction of your financing. We're also going to provide disclosures to you that match what we've reviewed in your consultation, and then begin the process by ordering your appraisal on the property. Your agent will be ordering inspections if elected on your property. This is what a deposit looks like for you for an earnest money deposit. It's 1 to 2% of your purchase price. Now that money is protected by what we call the contingency period. And what the contingency is, it's like an investigative period for you during the home process. It's usually in the first 14 days of the contract, allows you to get your house appraised, get your house inspected, and get your loan approved. And why I mention that is because your deposit is protected while you're in that contingency period. So you can confidently kind of do all your due diligence on the house and know that your deposit is not at risk. Now, behind the scenes, we're doing administrative work on the loan. It's called the processing of the loan. We're verifying your employment, assets, probably locking in your interest rate by that time, and preparing everything to go to the next milestone, which is called underwriting. And that's where an underwriter is reviewing all of your application, your proof of income, your assets, the program type, and issuing a loan approval. And that loan approval will have some items that we need to kind of work with you on, but it's part of the process as we kind of get prepared for the closing side of things. Now, it also will probably be around week 2 or week 3 in the process. It'll also bring you to the end of your contingency period. So after getting your inspections done, having your appraisal that hopefully has a value that supports your purchase price, and getting your loan approved, then you have the option to sign off on your contingency. And that tells the seller that you've done all your investigative work, you feel still good about the house, and you're going to move to the final stages. At that time, now you're kind of all in the process. So now you don't have that protection of the contingency because now you're expected to move to the final stages. As a lender, we're also going to issue to you a final closing disclosure. It's going to give you a 3-day cooling off period to make sure all the numbers match up on your disclosures before we get to the final milestone. And that's called closing the loan. This is really the only in-person step you'll need to do in the loan process. It's where you're signing final loan documents in person with a public notary. All the disclosures you receive up to that point are all e-disclosure documents, but that last stage is all in person. On that date, you'll also be expected to wire in your final funds for your closing. As a lender, we deliver the final funds for both your first mortgage and any assistance programs you've elected. And those monies get reconciled by an escrow team. And once everything gets kind of balanced out, they record documents with the county recorder's office. In fact, our county recorder's office is 2 blocks from our office here in downtown. But what they do is they record the grant deed that transfers ownership to you, as well as the deed of trust, which is the loan agreement. And so once everything gets recorded, then we get a chance to celebrate. I got a chance to make a couple of those calls this morning because I would get to congratulate you on now that you're the homeowner. And that's a celebration. Obviously, it's a huge step for you financially, and we want to be there to celebrate you right along with you. So, and we like to always send a nice little housewarming gift to our clients once they close escrow, because it's a big deal, right? It's going to be one of the biggest financial decisions you guys decide to make, and we want to make sure that it's a smooth process for you and it's an amazing experience. All right, so that's a little bit about our 6 steps of home buying. I'm going to grab a quick question in the chat. What options do I have if I'm considering bankruptcy before buying? So, I mean, that's that's going to be a little bit of a challenge because bankruptcy will put a timeline out of at least 2 years before purchasing. So that would make it a little bit more difficult. If you're considering bankruptcy, just know that it'll probably push the buying timeline out a couple years. And the other question was, what are the rates after buying points in CalHFA loans right now? That's a great question. I honestly wouldn't probably recommend buying points on CalHFA loans unless you absolutely have to, because the break-even mark on buying points right now is about 3 to 4 years. When we talked about interest rates earlier in tonight's discussion, the market will probably turn for refinancing in a couple years. So quite honestly, it doesn't really make a lot of sense to buy points with a break-even at three or 4 years when you're probably going to refinance in 2 years. But you can do it, and the same kind of math applies where you can pay 1% and bring down the rate 0.25%. But I honestly don't really recommend it in today's market. So after attending tonight's class, if you want to get connected to design your own home buying plan, we love to be able to meet with you for a consultation. It's a free service that we provide. You're meeting one-on-one with me. It's about a 30-minute video session. To get started in that process, you complete an online application, you upload proof of income and assets, and then you use our scheduling system to schedule a time that's convenient for you. And we really try to make ourselves available for you to really help provide the framework for you in home buying. Now, if you're thinking about maybe home buying, maybe you're a little on the fence about it, you just want to ask a few follow-up questions, maybe about interest rates, market conditions, maybe a scenario for you, schedule an introductory call with us. That's a 15-minute session with myself or one of our team members, and we'll kind of help answer any questions you have for us. We want to make sure you guys have all the right tools and resources to help you on this path towards home ownership. Here's what a consultation looks like for you. It's, talking about where do I want to purchase? What does my budget look like? I mean, what resources do I need to have, like first-time buyer programs? Can we help you build a savings plan? Are there some opportunities around credit? All those things, we'll have that discussion for you in that 30-minute session. I got some questions stacking up in the chat, so I'm going to answer those as we kind of get to the top of the hour. This is the mobile app I mentioned to you earlier. So if you're thinking about doing some payment calculations, great tool to use. You can also start the application process all mobile or desktop. And also, it's going to push milestones to you as you move through that home buying process. Of course, it's available for Android and Apple. I'd really highly encourage you to check out that resource for you. Obviously, we're super proud of our Sac State Alumni and Athletics partnership. Really proud to be kind of a local partner here. And we do have other partnerships both in California, but across the country that are continuing to grow, that we provide very similar resources to. So if you have friends, family, or coworkers that you think might benefit from some of our classwork that we do, or maybe are connected with some of our partnerships, we love to have you have them get connected with us. You can see our full list of classes that we have upcoming for the balance of 2024 at mortgageeducate.com. So as we're getting to the end of tonight's class, I want to go dive into a few of these questions, and then we'll kind of wrap up tonight's class. And so let me just make sure. I know we got some questions that are kind of flowing in the chat. So I think the question was, how stable are these services? I think you might be referring to first-time buyer services. If we feel better about starting the process a year, how likely are these things to be the same options we have at that time? So I think your question is, are the first-time buyer programs available typically? So yes, the CalHFA Assistance Program has been around for several decades. And so that program never goes away. So that, that's always going to be around. And, we'll see that maybe change in different iterations, like the California Dream for All program may come again back in 2025. It may change in different iterations, but generally these first-time buyer programs are always available. So yeah, and whether you're thinking about buying in a month or two or a year or two, these resources are available, and we'll help meet with you, whatever your timeline might look like. And yes, the question in chat, the recording will be available. So all of tonight's class will be recorded. Okay, great. I think I'm up to date there. Let me just make sure in the Q&A, we got some questions back and forth. So questions, what do you look for when selecting a mortgage lender? Well, versus versus which one is better than others. So of course, we are a mortgage lender. So I think at the same time, I think all mortgage lenders don't operate the same. I think, for us, I think what's really important in our world is, being highly educational for our clients, have a high touch process where you're having interactions with your lender. While we leverage technology, I mean, I think we're very technologically advanced as an organization. I think having still a human touch behind that, being able to reach out to me with a text message or a call or an email and get immediate response, I think is super important. And then finally, I think having the level of experience. In today's market, you have to have the right support for you. And so, I think, obviously I'm a bit biased because I think APM's and our team is an amazing choice, but there are obviously a plethora of different options out there. In the lending world, there's different channels you can go down. There's a direct lending source, which is what American Pacific Mortgage is. So we work directly with Fannie Mae, Freddie Mac, and FHA and VA. There's a bank, which would be like a Wells Fargo Chase, and there's kind of brokers, which would work as kind of a middle person between you and the source of funds. So there's a variety of different channels you can go down. And obviously you got to find the fit that's best for you. But I mean, at least for our team, we're really focused on some of those characteristics that I mentioned earlier. This is all my contact information. So if you have questions tonight after a class, feel free to reach out to me. We want to make sure that we get you all the tools and resources that you need. And after tonight's class, we'd encourage you to follow us on our socials. YouTube, we'll not only put this recorded version up there, but there's a lot of different other videos that you can check out from past classes that we've done. And then on our Instagram, we're always putting updates on our socials just to make sure you have great information to help you as a first-time buyer. You can follow us at JMeda Mortgage. And we love what our clients say about us in our communities that we serve. So check out some of our testimonials on Google. And, it's always kind of cool when we're on Reddit and we see some of the testimonials that are just recommendations that we see on platforms like that. We're really proud of what we do. We don't take this, lightly in our role in your experience towards home buying. So that's why, we want to make sure that you get nothing but the best level of experience and to have all the tools and resources that you need. And hopefully this class is a resource that you guys have found super useful for tonight. And we're at the top of the hour, just beyond the top of the hour. And I think I've answered all of our questions. So before we sign off tonight and let you guys get back to your evenings, I just want to see if there's any questions that we have from the audience that I can help answer. Okay, I think we're there.